Good morning, traders and investors. Roger Scott here, senior strategist for Wealth Press. It's Tuesday. It's June 13th. It's about 7:58 in the morning. The market's going to gear up to open in about an hour and 32 minutes. For those that are new to this, please like our YouTube Wealth Press channel, subscribe to our videos, and post comments. I really enjoy those comments, and I respond to every question. Now, let's get into today's analysis. Now, the market's going to open up in about an hour and 32 minutes. As I mentioned, Nasdaq right now is up about 30 ticks. My confidence in the Nasdaq is not very high. The Dow a little bit better, but not as high as well. I think the market is getting ready for some downturns, and I'll explain why. First of all, before we get into the nitty-gritty, want you guys to understand that today we have the CPI report, and one of the reasons why the Fed is pausing interest rates tomorrow, you'll see, I'm predicting the future with a pretty high degree of certainty. The odds are about 75% that they're going to not raise rates, is because they're cautiously optimistic that their hiking rates and policy changes are making a difference. The problem is, I'm not sure they're making as big of a difference as they think, and they're taking a wait-and-see approach. So if you hear tomorrow the Fed talking about possibly starting to reduce rates long-term, it's a bunch of nonsense. This is a wait-and-see. The sentiment is not all that great, and one of the reasons tech is rallying so high is because rates probably will not go higher. But the problem is, it's not a long-term solution. It's a Band-Aid, and that's something the technology sector is not seeing just yet, and that's a huge, huge problem. So what we're looking at today is we're looking at X and food and energy. It's coming out in about half an hour. We're looking at X food and energy to be about 5.3. Honestly, anything below 5.5 is good enough. 5.4 is fine, 5.3, 5.2. We just want this number to be lower, and we want the year-to-year without the core to be lower as well, which I think it will be. But we want the core number to be lower by at least 0.1 percent points because that would show that what the Fed is doing is, in fact, working, and consumer prices are declining and not increasing, which is the whole goal of this exercise. So keep an eye on that as well. Some other factors you need to pay attention to is that the markets may be a little bit subdued going into the PPI tomorrow and the FOMC announcement, but at least today we'll have a pretty good piece of a puzzle of whether the certainty of them not taking action tomorrow is pretty much crystallized or not. Another major factor you should be paying attention to is Apple was downgraded this morning. Now, yesterday we talked about Apple reaching all-time highs, and it did for a little bit. But typically when prices move, especially in this kind of market, when prices break out to all-time highs, you got to be really careful. This is not a momentum-driven market. You could argue with me and laugh at me and say, well, Roger, I disagree with you. It has been for tech for the last month and a half, but generally speaking, this is still a counter-trend market, and we are still in a bearish market environment. And if you think otherwise, you're going to be feeling it. So we might have missed this tech rally, but we didn't get hurt too badly by it, which is very, very important. So Apple is really overbought right now. Matter of fact, even when I moved this to a 5-day RSI, you could see, I don't even know why we have volume here. Volume is pretty low right now. You could see that prices are as overbought as they were right here or right here. The point is, or even right here, the point is this is a really overbought stock, and it was downgraded to neutral today, and I'll talk about that in a minute. And that can really cause the Nasdaq to come down because Apple is the second largest asset in the QQQ. I thought it was the first, but actually Microsoft took over, as you'll see in a second. See there? Microsoft. So Apple is 12% of the QQQ, and it was downgraded this morning. So you got to be really careful. Another factor you need to start paying attention to is volatility. Volatility, I believe, is going to stay in this channel, maybe break out, but I think volatility is going to start rising. Watch for VIX. This is the VIX. You could trade this asset right here, VXX. I think volatility is going to be spiking, but I would prefer you would buy an option on the VIX, on this one right here. And I think volatility is going to be going up to 20 in the near term. The options here are not very expensive. You can get an option that expires in 15 days. I would probably go to 22 days, maybe even 30 days. Yeah, 29 days. There you go. 29 days. You need to wait for the market to open, but I'm sure you'll be able to find liquidity on these. If you go to monthly, there we go, 36 days. That's where all the liquidity is. You can get the 15 for about $2.62. You can get the 14 for $13.35. You can get to 16, but don't go above that. 14 through 16, we may have a little bit of a downward spiral. Also, the Dow is also reaching. Let me go to the 5-day. Yeah, there it is. It's 5-day RSI. You could see here we haven't been at these levels. This is the third time this year we're at these levels, and typically we break down. Also, industrial is doing exactly the same thing. So be really careful, because I'm expecting the market to have a little bit of a downturn. Watching the bond market, bonds look like they can go a little higher, because if the Fed doesn't take action tomorrow, which I don't think they will, it'll give us a little bit of a trajectory to the upside on the bond market. Now let's talk a little bit about what we can expect today in terms of fundamentals and where the fundamentals are, and then I'll talk about strongest sector, strongest stock, weakest sector, weakest stock. So market participants braced themselves for the release of very crucial U.S. inflation data while awaiting a pause in Federal Reserve's most aggressive tightening campaigns witnessed in decades. That's why I'm getting very skeptical about this market's upside. Momentum levels, everything is telling me that we need to turn around pretty quickly, at least in the short term. Wall Street's major averages ended with a solid gain. Benchmark S&P 500 climbed to a 13.5-month high. Blue chips rising to a 6-week high. I'm telling you, folks, we're still in a nasty market. This is just an aberration, if you will. Carnival Corporation surged over 12%. I told you to keep your eyes on those cruise liners. For the first time, they're actually moving. And was a top percentage gainer in the S&P 500 after JP Morgan upgraded the stock. Bearish side, Nasdaq, the actual stock, plunged over 11% after the exchange operator said it would buy financial software firm Adenza. Energy stocks are also weakening. It's actually the weakest sector right now if you look at my sector scan. The Federal Reserve commenced its 2-day meeting and with investors widely anticipating that the central bank will implement a pause, not a turnaround, a pause on its long-running policy tightening cycle tomorrow. Everybody's focused on Mr. Squirrely talking. That'll be the biggest factor. Today, we're looking at the CPI, which is the prequel to tomorrow's report. Most investors are looking at the CPI. The Fed is looking at the core CPI. And they're not looking at it month over month. They're looking at it year over year. So they're looking for it to. They're looking for a figure of 5.5% year over year. They're looking for this number to be lower. I'm hoping it's going to be 5.3, 5.2. That would be terrific. If it's not, that'll be a big red flag for the market, and the Fed will have some explaining to do. But I think they're gonna pause and not take any action. If the CPI is positive, the bond market should rally on that, because that would cement the fact that they're not going to take action. Europe is up slightly, led by gains in tech stocks. A lot of concerns and optimism that the Fed is going to pause its tightening campaign. But folks, even if they tighten, that doesn't cause 6 of the biggest tech stocks to go up. That's AI driven. China's central bank decision to cut its short-term lending rate also lifted market sentiment. They've got to do it. China is in a big mess right now. China closed slightly higher after central bank cut a short-term policy lending rate in a bid to prop up country's flagging economy. That's bullish. That may cause a little bit of an upside here in the U.S. Japan is rocking and rolling. They closed above 33,000 for the first time in 33 years, led by higher value technology stocks. Also, Japanese chip-exposed stocks gained ground after Wall Street Journal suggested manufacturing in South Korea and Taiwan would be permitted to uphold their infrastructure in China. That would be amazing. China's really desperate right now, so they may be bending a little bit, and that would be really fantastic for everybody, including them, despite existing U.S. sanctions against the country. Again, anything that can be worked out, China is vulnerable, so they may start bending for the U.S. a little bit in terms of regulation. Oracle, I told you to watch Oracle the last 15 minutes of the day yesterday. The stock came out with earnings, 4% pre-market. I love what I'm seeing. Apple, as I mentioned, Apple is downgraded. UBS downgraded it to neutral from buy, which I think is a good idea, and I think we're going to see more downgrades. But remember, Apple is 12.5% of the QQQ, so there's a lot of vulnerability there. That's why we have to watch that CPI really carefully right now. And where was I? Apple. Devon Energy rose. Goldman Sachs upgraded it. But again, energies are just not doing all that great, and there's no major earnings right now. Now, looking at all the sectors, technology is still leading. And energy is lagging. So if we go to our chart and we go to the S&P 500, let's go to the longer term one. You could see here Nvidia, Netflix, that's the consumer discretionary stock. Honestly, in my opinion, in my humble opinion, I wouldn't be going with technology. If you want to go with technology, Nvidia and Netflix are your best bets. Honestly, I would go with something like Pulte Homes and General Electric because it has less sensitivity to interest rates than these stocks. So I do understand, but I think industrial stocks are the second or the third or second behind technology, consumer discretionary communication. And I'm putting them all in the same sector. But I would go with either Nvidia if you want to play that game, but I like General Electric. Royal Caribbean looks pretty good, but I would really go with General Electric. I like the way it's trending, or Pulte Homes. But if you want to stay with technology, you got Nvidia and consumer discretionary Netflix right there. But I am telling you that technology is not going to stand up to all of this. Just too much too fast. Way too much too fast. On the weakest stocks, let's look at the weakest stocks. This stock, VFC, man, I hate this stock. I would short this stock. I think Jack Carter is shorting this stock right now. On this stock, the bank stocks are still moving lower. They're not really doing us any favors. And in this case, let's see here. Dominion Energy right here. D, ticker symbol D. Or if we go a little further down, let's see here. There's definitely some energy stocks that are looking crappy. We just have to find them. There we go. Devon Energy, which just got upgraded actually. It's not looking all that great. One of the weakest energy stocks. And that's Enphase. That's solar. Let's see here. I'm sure I could find a good one here. They're not that low. Duke Energy, another one. But these are utilities. But utilities are not looking great either. So Duke Energy or where's that other one that I had right here? Had it here just recently, a minute ago. Dominion Energy. Duke Energy or Dominion Energy. The utilities and energies right now are just not looking all that great, especially with interest rates being ascending versus descending. I think both of those stocks will come down. So utilities, energies, they're just not looking all that great right now. Now, before I let you go, I've got something important for you. I'm going live today at 1 p.m. Eastern Time with a master trader, Chuck Hughes, to cover how we're preparing for Wednesday's FOMC rate decision. Now, a few short weeks ago, everyone was celebrating what we thought was the last rate hike. No. But now that's all up in the air, and there's no telling what squirrely Jerome Powell and his Fed cronies will do. You know that. So we're gearing up for what will be a very pivotal decision. It has everything to do with taking what the market is giving us and making the best out of it. And sometimes it's best to go for a base hit instead of swinging for the fences. That's right. And this is definitely this kind of market. Apple being downgraded, the Dow being overbought right now. I mean, looking a lot like industrial. There's a lot of vulnerability. Me talking about volatility, rallying. This is not a time to swing for the fences. This is a time for base hits. Click the link below and reserve your seat to hear our game plan. And it's going to be a great one. You do not want to miss today's session. Follow the link below. Check it out. It's happening at 1 p.m. Eastern Time on Tuesday, June 13th, right after the CPI. We'll give you an update on the CPI. We'll talk about tomorrow's Fed announcement, do a little market update, and get you ready for the FOMC tomorrow. You don't want to miss out. Follow the link below. If you're watching this on the YouTube Wealth Press channel, like our video, subscribe to our channel, and post comments. I respond to them daily. I sure do, and I know who you are. Bye, guys. Have a great day, and good luck with the CPI. Keep your eye on the core CPI. That's where the money is. And don't forget, we're looking at 5.3. Don't forget, follow the link below. Sign up. Chuck and I are going live. You can ask us all the questions about market action live, 1 p.m. Eastern Time. Again, not a time to hit home runs. This is a time to hit base hits, not swinging like a maniac. Base hits. See you guys. Bye.